Welcome to this video, which is on how to produce an integrated cash flow forecast. We have the outputs of our cash flow forecast, and the turnover is changing, and the expenses are changing, and the depreciation is changing, and the interest charges are as well. And so we got all of our inputs are changing, our assumptions are changing, and it's updating the balance sheet, and the balance sheet is driving the cash flow, and that's feeding back into the cash line here, and our balance sheet is still balancing with our assets equal to our reserves. How did this sort of work? There's no balancing figures in here. It's all entirely equation driven. So in this video, I'm going to take you through how to do it. It looks complex, but actually it's quite simple, provided that you follow specific rules and approach. Once you move outside the rules and approach, that's why cash flow forecasts become much more complicated and why finance directors struggle to be able to produce these because they move outside the rules. I'm going to take you through a very simple cash flow forecast in this video. I'll take you through the objectives, the rules, and the approach. I'll explain what you need before we start, and then we'll actually get into the cash flow forecast and see how we produce it. In terms of our objectives, we're after something which we can quickly alter. So as you can see here, I was quickly changing the turnover and the expenses, and actually I was changing the fixed asset additions as well, and I was changing the loans. And you can see it's changing really quickly. So that's the first thing that we want, is we want a spreadsheet, well, a cash flow forecast that can change quickly. We need to be accurate, we need to add up, and that's accurate and adding up without balancing figures in there. So if I just go back into here, you can see that there's no balancing figures in here. It's all equation driven. This is coming off the profit loss account. This is coming off the balance sheet, and the cash figure is coming off the cash flow. There's no balancing figures within this spreadsheet. We want to be able to see where the calculations are coming from and to unpick the errors. You're very unlikely to get your cash flow spot on straight away. Alternatively, somebody else needs to be able to sort of see what's going on in your cash flow. And so you want to be able to sort of get quickly back to where the initial inputs were, or wherever the errors are, be able to sort of tick off and check it, either to find out where your error is. So we need to create a structure up front that actually allows us to do that. And then we want to be able to update our cash flow later on. We've decided that instead of having fixed assets being calculated in the balance sheet, we're going to have a specific sort of projects sheet there. We're going to have 10 different projects, and we're showing the different cash flows. So how do we create a structure that can work? So that's what we're going to do. In terms of rules, what must be done in terms of when you're creating a cash flow forecast? You must never have a cell that points at two worksheets. So if we use the direct cash flow method, we'd have turnover coming in, let's say receipts from income line X, income line number 1. There. That would point at the profit loss account and the change in the balance sheet data figure. So that cell would point at two worksheets. That now makes it much more complex to be able to find your errors. You're now going to have to cut one over here, then you're going to have to write it down, then you're going to have to add it up to that, and then you have to compare and see whether you got it right or not, really. So it's much more messy if you ever have cells that point at two worksheets. So no cell must ever point at two worksheets. And similarly, what we'd have is we should have cells pointing to the inputs as early as possible, because really we don't want calculations pointing at more than two cells. So if you go back here, this is going straight back into the profit and loss account. This is going straight back into the balance sheet, and this is going straight to the cash flow forecast. The cash flow forecast could have worked out off the balance sheet down here, and then we could have a cash flow forecast down here that was working off this balance sheet, and this balance sheet could have probably pointed at this profit and loss account in here. And instead of doing that, we go straight back to the initial workings as quickly as possible. Why do we do that? Well, what it does is it means that when you're trying to find your errors, you're not having to go through one cell, to the other cell, to the other cell, to the other cell. Oh, now I find where the initial input is that I've got to change. So it's going straight back to the initial cell. We use the indirect cash flow method, and that is because we don't want our cells to point at more than two worksheets. But also as well, it's much better in terms of being able to see, well, what is actually driving the cash flow movements, because we have our turnover and our turnover and our expenses separate from our changes in debtors and changes in creditors, and that's the big weakness of the direct cash flow method. If you really need the direct cash flow method, create your spreadsheet, and then at the end of it, in the reporting side, create an indirect cash flow method. But you never use your indirect cash flow method to actually drive as the workings in this spreadsheet. And we don't have any hard-coded data. We don't put in, once we do our initial inputs. So in this profit loss account, I've got initial inputs here, which I'm actually using at random. Once I've used these initial inputs in here, there is now no more sort of changes. Everything else after that point is all equation driven. So we have our initial inputs. We don't do an input in the middle of our spreadsheet, and the reason for that is that we have to find it. So that's our rules. You mustn't break those rules. As soon as you break those rules, your cash flow becomes infinitely more complex and much more prone to error. In terms of our approach, then, how do we do this? You can see I produced different coloured worksheets here. We've got the solid core that we're going to have. This is our solid core for workings. So our profit and loss account, a balance sheet, and a cash flow forecast. We put a cash flow statement. We put these on separate worksheets, and we don't want to have them mixed in together. Yeah. And we only have 3. We don't separate these into one bit over here, one bit over here, one bit over here. We have a full profit and loss account, a full balance sheet, and a full cash flow. The reason for that is on the one hand, it's just simpler, but you also, as well, at the end of it, will need to reconcile. So you need to have totals that you want to reconcile. Our inputs feed this core. So here I've decided I'm going to calculate the debtors and the creditors in a much more detailed figure than just simply putting down the debtors figure. I'm going to have the debtors and the creditors calculated off the basis of turnover or expenses. So I'm going to have the separate calculations outside here, and they're going to feed the core. I could change in the balance sheet and the fixed asset additions. I could have a project tab in here with a whole series of cash flows for all my various different projects, and that could be feeding the core. But I've got my inputs that feed the core. I then also report separately to the core. The core, the workings core, is quite messy. If you try to make that neat from a reporting point of view, it just won't work. So we have our messy workings thing in here, and then we have our neat reporting side at the end of it. Then what you'll see is that I'm using accounting conventions throughout. So I'm going to change this now. Use accounting conventions throughout. So income, turnover is credits. Expenses are debits. That kind of debit credit thing throughout. Some people like to go just pull up positive numbers, but actually it makes it much harder when you're doing this later on because, okay, I've got a credit here, and then, right, okay, that should be positive because it's debit. If you just get used and you hold to accounting convention, it's much easier to trace your numbers through. And also you're basically producing two sides of the journal. So we use accounting conventions throughout in our workings. And then in our reporting, if you wanted to change that so that it's positive, well, we just do minus, and then we do our turnover figures. So that's our approach. Those are the 4 ways. So these are the 4 rules that we must follow. These are the 4 ways that we build a spreadsheet. Now, before we start getting into this, then what do we actually need to be able to produce a cash flow forecast? Well, you need to have a good grasp of double entry bookkeeping, because essentially what this is a double entry bookkeeping exercise with a bit of Excel thrown in. There's a bit of Excel knowledge which you're going to learn from this video, but there's the good grasp of double entry bookkeeping which you need before you enter that one. There's a video on our channel which you can sort of see double entry bookkeeping and explained in a more simple way. So let's get on with it now. So I've got my reporting here, and in this thing I've got 7 turnover lines and 4 expenses lines in here. But in my detail, because I've got 23 different actual turnover lines in my accounting system in there, and 19 ones there, but I want to summarize these things up into just these figures for my outputs or my board or whatever it is that I'm going to report to. So the first thing that I do is I'll have the names of my granular turnover lines, but I'm going to put next to them a summary. I'm going to give it a summary line. So how do I do this? Well, you can see a couple of times I'm going to be using data validation. So it's in data validation, and then lists. And so what I've done is I've set in these particular lines some data validation. It can only be this in this particular cell here. I go down there and I assign my different summary lines in these cells. And that allows me to use a sum if equation. You'll see that we use data validation first of all, and then we're using sum ifs. So we're going sum ifs, look in that column there, column B. And when you find A2, add up what's ever in column F, which is the yearly turnover. So in terms of getting simple reporting, we'll use data validations if you're wanting to try and summarize up this thing. So we don't really want to have this massively long profit and loss account there. In the same way in the balance sheet, we could have lots and lots of different balance sheet lines. We want to summarize them up into particular things like, say, other debtors or what have you. And the way we do that then is we use data validation to create very specific names for this one. This isn't turnover 1, turnover 2, turnover turn 3, or whatever. This is data validation for that one. And then we use a sum if equation to get it together. Now, I randomized these inputs, but really I might have hard-coded this bit, first of all. So I might have hard-coded the turnover and the expenses line. I only do the first year. After that, I put in growth over here. And the reason why is because I might want to change these quickly. So I might want to say, well, actually, that 5% is not going to be 5%, it's going to be 10%. And now it will update. So that will be 10% higher than that. So I can quickly change it. If I put that actually in here and put these hard-coded these numbers there, though, whenever I wanted to change these, I'd have to go back and type them all over. It's quite a pain, really. So in terms of, let's say, well, actually, if I want to run a sensitivity whereby there's no growth in turnover, but the expenses stay the same. So that allows me to do it quickly. Once I've produced that in terms of my yearly turnover numbers and my yearly expenses, I'm now going to turn that into monthly figures. So I have a seasonality man here. So I've mainly gone for 12 here, but in this one here, I've gone that it's all going to be in month 7. So how did I do that? Well, firstly, I apply to each one of my months in my cash flow forecast a year and a month. So I go through and I produce a year, so whatever year it is. So we got year 1, year 2, year 3, year 4. I then also produce a month figure. And what I'm doing then is I'm going to go for, first of all, I'm going to use a sum if and go, right, okay, find year 1 in this, and then add up whatever it is in here. So this is year 1 here, 134,000, and that's that first bit there. I then find month 1. So it's month 1, so that's the Z2 bit of the sum if equation. Find month 1 in here, and multiply it by this percentage here. So you can see that that is 0 there, but then there's 100% in month 7. So in month 7, it all goes in there. So I've used 2 sum if equations next to each other to pull the yearly turnover and multiply it by the seasonality. So I'm going to produce my yearly turnover first, or my yearly P&L first, then I'm going to produce the seasonality by month, and then I'm going to use a sum if equation to produce that seasonality by month. Yeah, that gives me my turnover and my expenses line. I've got depreciation and interest charges, and they're going to come in from the balance sheet. So I'm going to leave those for the moment. Now I've produced my turnover and my expenses. I'm going to want to turn this turnover figure into a debtors figure though as well. So what I've done as well is back here, I've also attached to each of these turnover lines a payment profile. So that one's paid in the month, that one's paid after 1 month, and I've sort of produced again data validation to produce a payment profile for both debtors and for creditors. In my debtors figure then, I now can have, well, this is the whole of the turnover that's associated with 1 month. It's going to be paid next month, after 2 months, after 3 months, after 4 months, and that's the amount that's going to be paid in the month. That allows me to then go, right, well, the amounts of debtors that are going to be for 1 month is going to be that. It's going to be 0 for that, and paid in the month, and that's going to be, that one's going to be paid off next month, and that's going to be paid this month. So it's one like that. I go through here, and then in 2 months' time, in the 2 months line, it's going to be both of those. But then after that, that one's going to be paid off, and that one's going to be added to it. In the 3 months line, it's going to be that, and then that. And then after that, you know, that one is paid and that one's added up. So I produce this thing down here, and eventually the 4 month data line is all 4 of those added up. And then after that, the next month, it's those 4. So I produce my debtors like that. I brought in my opening balance sheet data from the balance sheet here, and then I've assumed that this is paid off in this particular profile in here. That gives me a debtors figure that's driven off my turnover figure. And the way that I did that then quickly was I assigned and I gave specific month names to my payment profile, and then I assigned those to my turnover lines. And then I had an equation that was telling me, right, okay, well, a 2 month debtor in the 3rd month is going to be that and that. That one's going to be paid off. And so that's how I produce my debtors figure. It's the same for creditors, exactly the same kind of method here. And you can see in terms of accounting equations, debit, expense, credit, creditor. And so I did the same thing in here. So the 3 month creditor here is, well, the 4 month creditor here is going to be that month, that month, that month, and that month. But that one's going to have been already paid. And so that's how we produce our debtors and creditors, and they will feed into and balance sheet. So you see there's the creditors figure and there's the debtors figure from our input sheet. I then go down and I produce my fixed assets position. Now I might produce a separate input sheet for fixed assets, and later on I might want to split out fixed assets into land and buildings and IT and equipment and whatever. So I produce that in a way. I've got this one here, which is this final position here, but if I wanted to then split this up into land and buildings, what have you, I'd add that in and I'd point it to my particular input sheet, but I'd still be using this solid core of whatever the carried forward figure would be. I then got depreciation, and in here I'm calculating the depreciation here. I'm using effectively a reducing balance depreciation calculation. I've got my additions coming in over here, which I've put in there. I've got a random figure of additions, but I could link that to an input sheet, and then the P&L account comes back into that debtors or that depreciation figure from the balance sheet. The interest figure is being picked up from this balance sheet figure as well. On my loans, I've got a figure in here for whatever my interest payment is going to be. Now, I did put just at 3%. I could put the interest charge out here and then calculate it like that. You could do that. And again, so the method you can improve and develop your equations or your spreadsheet over time. And that then gives me my net assets down here. But at this point in time in here, I haven't really got my cash flow forecast. My cash flow here. So you can see at the moment, I've got my balance sheet not balancing in here. Now it will balance on here. You see it's still balancing in here, and that's because this cash flow here is pointing right back to the initial cash flow. But let's say that at the moment I've not produced this. The next thing that you produce, then, is you're going to produce your cash flow forecast, and you're going to use the indirect method of cash flow forecasting. So the profit loss in the month, add back in depreciation, add back our interest, do the change in debtors based on our balance sheet. So this is our change in our balance sheet. And you can see how all of these calculations, they are only pointing at one different worksheet. So if you find an error, you're not having to go through and pile through 2 or 3 different worksheets. You're only going back to one worksheet if it's not adding up and ticking them off. You're printing out the balance sheet and you're just going through and just tick, tick, tick. I got my fixed asset purchase going off the balance sheet. I got my loan repayments coming in here. So that's got my indirect cash flow method to produce brought forward cash, carry forward cash. So you see in here, this was coming off the opening balance sheet, and I had 0 cash to start with, and that's my carry forward cash. I then come into this balance sheet, I make that equal to the carry forward cash at the end of month 1, and you can see now that that now balances. I drag that across to here, and we can see that now my net assets is equal to my reserves. And that's it, really. I then produced finally the reporting sort of side. I got over my I summarized my turnover into just these 7 lines, and to do that I did a sum if calculation. Here I've got this reporting section nicely out here, not messed up within the workings in here, and so it's nice and neat. I can then sort of format it however I want it to be. I've pointed these things back to the P&L account, to the balance sheet, so I'm trying to get back as fast as as further as I can in the spreadsheet, rather than trying to go through wanting this, so that if there was an issue and this wasn't adding up, I could just compare. Most importantly, though, if somebody else was picking this up as well, they can see, right, well, that goes straight back to there. That's the cash flow figure. That's going straight to the balance sheet. They're not having to go through one cell to another cell to another cell to another cell. So whilst it might be slightly faster for you to produce it, if you wanted to, if you had a cash flow forecast, let's say here, running off this balance sheet, it's longer for the person to review it. So that's why you go back to the initial sheet. That's it, really. Hopefully that was helpful about how you produce these ones. Good luck with your own cash flow forecasts. Leave any comments in the comment section. Leave a like if you feel like to as well. Much appreciated. Thanks for listening. Bye bye.